In this video, we will be discussing the concept of expected value and why this equation is the most important formula in all of trading. So what is the expected value? EV, or expected value, is a concept from statistics which is incredibly applicable in the use of trading, because trading ultimately is just statistics and thinking in bets. So now let's break it down. The expected value equation effectively takes the risk reward and the win rate and puts them together to determine how much is expected over a large series of bets from a given trade. So let's say on one trade, even if it has a positive expected value, you might win money or lose money. However, if you have a certain strategy that has a certain expected value, over 10,000 trades, the real value, so the value, the median or the mean value observed, should converge towards the expected value, which is effectively what you should expect to see over sufficient samples. And many of you might be aware of this concept. It's a very commonly discussed concept in trading. However, what I find through interacting with hundreds of people in our community is that not many people understand the trade-offs related to risk reward and win rate when discussing expected value. Quite often people come to me and they say, I want a bot that has a super high win rate and a very good risk reward. And ultimately, those two values tend to be inversely correlated just due to mathematical and statistical properties. In this video, I really want to break down why that is based on my experience generating hundreds and thousands of expert advisors and effectively discuss what is important and what these trade-offs might be. So let's first break down what the actual equation is. The expected value, you simply take your win rate, so the probability, the percentage of time which you are right, times how much you make when you win. And then we would add that to your losing rate, which is just 1 minus your win rate in percent, times how much you lose when you're wrong. And effectively, if you add this up together, this will give you the expected value for a given trade. And what this means is that if you have a super high win rate, your risk reward does not need to be that high. So if you win 99% of the time, this number can be significantly smaller than this number. However, if your win rate is super low, the amount you make when you win needs to be significantly larger than the amount you make or the amount you lose when you're wrong for this value to be positive. And ultimately, the term positive EV refers to typically a profitable strategy in trading, whereas negative EV would refer to a money-losing negative strategy in trading. And really, the EV is your edge, right? If you have positive expected value, that means that you have an edge in trading. Whereas if you have a negative expected value, it means that this strategy has no statistical edge and you are effectively losing money. Or in fact, that has probably a negative edge. Whereas if you have an EV of 0, that means that you're simply matching randomness. And there's no, assuming that there's no spreads, no commissions, and it's a perfect market environment, EV of 0 would indicate that you're simply trading in a totally random environment. But unfortunately, because we do trade in a real market that has spreads and commissions, if you actually do have a strategy with no edge, you will ultimately lose money. And in this video as well, I wanted to discuss the concept of edge over randomness and effectively showing that a good trading strategy has to have a win rate which is higher than whatever the random percent would be based on the risk reward. And that's what this little graph breaks down. What many people need to understand is that when it comes to developing trading strategies, your win rate will usually be inversely correlated to your risk reward. And think about it. I'm sure you've all seen these EAs on the MQL5 marketplace that have enormous stop losses and they have tiny take profits. And they're right like 99.9% of the time until they ultimately blow up. Why is that? And essentially the conclusion is that your win rate and your risk reward is inversely correlated. So that means if you have a very high win rate, typically you need to have a low risk reward. And alternatively, if you have a super high risk reward, your win rate is likely going to be quite a bit lower. And why is this? I'm sure you can 100% prove this through mathematical formulas and proofs, but I'm going to do it in a very illustrative example. Imagine we have a take profit and we have a stop loss, and they're both the exact same distance away from where we buy. Let's say $1, $1. In a totally random environment, how many times over the long term should we hit the top versus should we hit the bottom? And the answer here is 50-50, right? Because let's say that randomness didn't apply, and it will hit the bottom 60% of the time. That means that you would simply short every single time. So by definition, you would not have a random scenario there. You would have a system with an edge because you could extract money from it. Whereas if we know if you have zero edge, your expected value should be zero. Therefore, any sort of imbalance here would make no sense under a completely random environment, provided your TP and your stop loss are exactly the same distance away. However, when we start modifying our TP to stop loss ratio, therefore modifying our risk reward, what happens to our win rate? And I always encourage you to kind of go back to the break-even concept. Like, what would the win rate be given the risk reward that would result in me making $0? Because you always assume I'm in a perfect market where there's no spreads, no slippage, no commissions, and it's just purely as like a mathematical experiment. In that case, you'd make $0 in a random scenario. So here, if your take profit was half the distance from your stop loss, how often should you hit the TP versus the stop loss? And obviously, these ratios start to change. So here, in a scenario where you make $0, because you make twice or you lose twice as much when you hit the stop loss than what you make when you hit the TP, by definition, to make $0, you would need to hit the TP 66% of the time. And lo and behold, in a totally random situation, the probabilities and your win rate here will converge to 66% in the event that your TP is twice as close as your stop loss. And the same thing applies if you reverse it, right? If your TP was twice as far as your stop loss, in a perfectly random situation, so you have no statistical edge, you would hit your TP 33% of the time, whereas you hit your stop loss 66% of the time. And in this scenario, that means you have zero edge. You're essentially flipping a coin. And in all of those scenarios, due to market impact, spreads, slippage, commissions, you will lose money. So ultimately, what does this actually mean for you? This means that when evaluating any sort of trading system, you should evaluate the win rate and the risk reward and look for the edge over randomness. So simple as that, if we were to have a one-to-one risk reward, what does our win rate need to be for us to make money? It has to be over 50%, right? Because if you lose $1 when you're wrong and you make $1 when you're right, you need to be right more often than you're wrong. And you can extrapolate that to here in the case of the half TP versus stop loss, so 0.5 risk reward, you would need to be right over 66% of the time to make money, so 70%. So when you run any of your EA back tests, what I always do is do a quick risk reward calculation and then look at the edge over randomness. If there's definitely a percentage edge over randomness and it seems reasonable, that makes total sense. However, also a great way to spot scam bots is to look for an edge which is ridiculous. Like for instance, having a 99% win rate with a super positive risk reward. That violates this entire commitment, this entire premise here, right? So being able to understand the concept of expected value, why it's important, and evaluate any sort of trading system on its edge over randomness is key. So you take the risk reward, you determine what the break-even win rate is, and then you calculate whatever the win rate you're actually seeing is relative to that edge, or relative, to the break-even win rate. If it's higher, you have a system with edge. And this is a very important concept. So always keep in mind that you will have to likely make a trade-off if using real trading systems between having super, super high risk reward or having a super, super high win rate. And the trick is to find something which has a pretty good win rate and that can also have super high risk reward. And that would be like our longbow bots. So those are actually phenomenal bots. Therefore, if you're interested in trying them out, I encourage you to click the link in the description to get a free trial. But ultimately, this is what I wanted to cover in the video today, guys. If you are trading, you need to understand this concept because it's ultimately the most fundamental effect and the most fundamental law of the market. So I hope you guys enjoyed the video. I'll see you in the next one, and take care.